Welcome to Sectors Up Close. I'm Elena Casas. Our sector today is US financials, and my guest is Aoifinn Devitt, the Chief Investment Officer of Moneta. The first half of this year was one of the rockiest for financials since the Great Recession. Rising interest rates created massive unrealised losses on the bond holdings of US banks, and that was partly to blame for the collapse of SVB, Signature and First Republic. And the sector isn't out of the woods. Bank of America says it alone is sitting on a $109 billion paper loss on its holdings, and that's left the bank's share price in limbo. The S&P 500 Financials Index is slightly down for the year. Compare that to the spectacular 30% gain seen in the Nasdaq in the first 6 months. The banking sub-index is down about 10%. But financials are more than just banks. The Financial Select Sector Fund, or XLF, tracks the index. As you can see here, its biggest component is Berkshire Hathaway. And in addition to major banks, it includes Visa and MasterCard, S&P Global and BlackRock. Some of these companies have done surprisingly well this year. So, how should investors approach the financial sector? Let's ask Moneta's Aoifinn Devitt. Aoifinn, hi, thanks for joining us. Do you think that the turmoil we've seen in the US banking sector thus far this year is essentially over, or do you think that if yields keep rising, we might find more banks get into trouble?
I don't think it's over yet. I think we're by no means out of the woods. This was perhaps a canary in the coal mine as to what that kind of deep recession in bonds can do for banks on their balance sheet. I don't think we've seen the end of this yet. The transmission effect, you could say, we talk about the monetary policy transmission effect. What about what the transmission effect is on bank balance sheets? Of course, there is a lagging indicator. We only find out at the end of every quarter what has happened to deposits in the past quarter. And as we know, it doesn't take much to send depositors into being spooked and to withdraw their funds and have a modern day bank run. That the timeline for that to happen is much shorter now. So I don't think we're out of the woods yet. That said, and we can see that with the Bank of America news, other financials though are perhaps having a different time, and we can talk about why.
Before we get on to that, do you think the Federal Reserve is almost at the end of its hiking cycle and therefore we've seen most of the downside for banks, or could there be further to go?
There could be further to go, I think, but there will be. We certainly expect, and consensus is, there will be 2 more further rate hikes this year. This pause is not really giving us much pause and much pause at all. So therefore, looking at those 2 additional rate hikes, there will be more pain. We are seeing in Europe, though, banks starting to push these gains, essentially interest rates, through to consumers in the form of interest rates on the deposit accounts. That's a very good sign, finally. But equally, we're not seeing that usual positive relationship between financials and a rising rate environment, simply because there's too much fallout, that collateral damage from the very steepness of the rate rise cycle in the past.
Moving beyond the banks then, are there companies in this sector that are perhaps almost recession-proof? I mean, we've seen very strong gains from Visa and MasterCard this year, for example.
Certainly, but that would be very much levered to consumer spending. And one of the most, I suppose, confounding elements of the markets year to date is the fact that this recession is a recession that perhaps barked but hasn't yet bitten, and the consumer remains very strong. We've just seen an uptick in consumer sentiment, and we've really seen no fall-off whatsoever in consumer spending. We're perhaps seeing the surplus of COVID move its way through. But equally, we spoke a lot about the digital economy and how digital assets are maybe encroaching into the world of finance. We're seeing increasingly cashless transactions. Of course, that means more use of credit cards. So as long as that credit card is a core component of the consumer's expenditure and that remains robust, I do think that they are recession-proof. They're not also seeing that loss of market share perhaps to digital currency that we've expected. That could come, but so far we haven't really seen that. So definitely some winners in there. And we can also talk about insurance. Insurance is having a field day right now in terms of its pricing power and the impact of AI and what that means for its underwriting capability.
From an investor's perspective then, should you buy XLF? Should you buy this sector broadly?
I think it's better from an investor standpoint to be much more selective, go stock by stock, sector by sector, or subsector by sector, should I say, within financials. Looking at XLF across the top, we can see it really hasn't performed year to date. It has been dragged down by some of those large financials. There will be a cloud over those financials until we see the end of the rate rise cycle. And because we just don't know what these write-offs, write-downs are going to mean, and we see the propensity of the depositor to be flighty, that's going to act as an overhang over the main components of this index. So I suggest instead going for some stock picking within the subsectors such as diversified financials, insurance, or those credit cards we talked about earlier.
Aoifinn Devitt, CEO of Moneta, thank you very much for joining us. Well, that was our look at the US financial sector. I'm Elena Casas, and this is Reuters.